Let's get your week started. Live from New York City this morning. Good morning, good morning. Just about positive on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, Biden and McCarthy to resume talks this week. As Secretary Yellen prepares to offer an ex-date update, the president says we've not reached the crunch point yet. From New York, we begin with the big issue. Debt ceiling talks resume tomorrow.
Well, I've learned a long time ago, and you know as well as I do, it's never as good to characterize a negotiation, the middle of a negotiation. I remain optimistic because I'm a congenital optimist. But I really think there's a desire on their part as well as ours to reach agreement. I think we'll be able to do it.
President Biden telling reporters that he expects to meet the Speaker of the House just a day before leaving for a G7 summit in Japan. National Economic Council Director Lael Brainard characterizing staff-level talks as constructive.
The staff is very engaged. I would characterize the engagement as serious, as constructive. The most important thing is making sure that Congress fulfills its basic responsibility to avert default.
Markets growing increasingly wary ahead of the so-called ex-date. Secretary Yellen telling Bloomberg, quote, "I don't want to be specific about when we do updates, when we think we have more information, but certainly within the next couple of weeks." Joining us now from D.C. is Bloomberg's Kayleigh Lyons. Hey, Kayleigh.
Hey, John. Well, a couple of weeks. We're expecting within the next 2 weeks because, remember, it is only 17 days from now that, in theory, as Treasury Secretary Janet Yellen said earlier this month, they could fail to fulfill their obligations as early as June 1st. So the clock is ticking toward that deadline. But, of course, the other deadline we are looking at within this week is Wednesday, John, when the president does plan to get on a plane to Japan for the G7 summit, which is why we expect this meeting between him and the big four congressional leaders, of course, most importantly, House Speaker Kevin McCarthy, to take place tomorrow. Now, we understand that staff continued to talk over the weekend. They will do so again today, and they have made some signs of progress, hence the optimistic tone we are hearing from officials from the Biden administration. Things that it looks like potentially there could be a compromise on include energy permitting reform, spending caps, though the duration maybe still has some daylight between the two parties, as well as the idea of COVID funding, unspent COVID funding being spent then in other places. There's also this narrative around work requirements for entitlements. The president, when speaking in Delaware over the weekend, said he does support some of that. He did support it in the past, which is now law. The one exception that he doesn't want to talk about is Medicaid. So we'll see where they can come together. What we understand is off the table is that the Democrats, the White House, do not want to touch the Inflation Reduction Act. So we're starting to see the contours of potentially where some agreement may take shape, John. But of course, the clock is ticking. We don't have that much time left. And remember, the Senate is expected to go on recess for the Memorial Day holiday on Thursday.
Well, right now we've got some soothing words from Brainard. The staff level talks, they're engaged, they are serious, they are constructive. But Kayleigh, to your point, are we running out of time here?
Well, time is definitely short, but we know that in Washington, things usually move slowly until you're up against a deadline. And that is really when it comes down to crunch time that a deal is made. And remember, House Speaker Kevin McCarthy himself said he would like to see a deal done this week. So we'll see how much progress they can make in that Tuesday meeting, John.
Kayleigh, thank you. With the update, Kayleigh Lyons down in Washington. Joining us now to discuss, Sam Linton-Brown of BNP alongside Colin Martin at Charles Schwab. Colin, first to you. Those words from Lael Brainard, and great to catch up with you, buddy, as always. The staff are very engaged. I'd characterise the engagement as serious, as constructive. Colin, anything to worry about here?
You know, we are optimistic that something will get done. I mean, we think the risk of an actual default or technical default is pretty slim. That's kind of our base case here. But there are risks, of course. When you look at the broad bond markets, if we want to focus in there, we really aren't seeing too much signs of stress, though. The only area we're seeing is in that really short-term Treasury bill market, specifically with bills maturing in the next few weeks. As you just alluded to, John, I mean, that deadline is coming up pretty quickly. So the number of bills we can actually look at that mature before that June 1st date is dwindling by the day. We see there's a huge premium there, and then we see yields jump based on the small risk, in our view, that you get some sort of deferred payment on those maturing bills. So if we look elsewhere in the market, it's really not showing much signs of stress, as I just alluded to. Credit markets are relatively calm. Treasury yields, intermediate and long term, are kind of in those ranges they've been in. So for now, it seems when you just look at those kind of indicators from the financial markets, it seems like there's some sort of optimism that a deal will get done.
Hey, Sam, to Colin's point, you've got these at-risk maturities pricing in some growing tension, elevated yields in various pockets of the T-bill curve. Beyond that, should we be pricing in any tension beyond that?
I think where you have some asymmetry here, John, is in FX markets. What we've seen historically is that when the debt ceiling is suspended, the dollar actually typically strengthens, and that's because liquidity contracts in the US as the Treasury rebuilds its general account. So I think you have some short-term asymmetry contrary to my structural medium-term bearish view on the dollar, where either you have a scenario in which, as Colin said, and we'd agree, the unlikely scenario, where something goes wrong, that's risk off. In that scenario, the dollar will rally versus equity-sensitive currencies. Or you're in the scenario, the more likely one, where there's an extension, liquidity contracts, and any initial weakness that we see in the dollar amidst an equity rally post that event is mitigated by liquidity contraction. So I think you have some near-term asymmetry both to the dollar and to risk assets on the downside.
Sam, what would the call be on the Treasury market? If it hits the fan, are you buying or selling Treasuries? That seems to be the question we've all got to ask ourselves here. Is it any different this time around? We caught up with Luke Hickmore of Aberdeen on Friday. He said the 5-year. I'm buying the 5-year. Things get messy. That's where I want to be. Where do you want to be?
In fact, we'd have a pretty similar view to the individual you mentioned from Aberdeen. That's a segment on the curve that we think in yield is a little bit high at the moment, and the 5-10s at this level is simply too flat. So on that type of risk-off outcome you mentioned, I'd agree. The 5-year point looks attractive. I think something like 5s, 10s, 30s fly in the US, where you're short the 10-year versus long the 5-year and 30-year, is quite a nice sort of duration-neutral normalization trade that also captures some of these near-term event risks.
Colin, does that resonate with you?
It does. Now, we don't have a specific target on the yield curve or where we would suggest our clients focus on, but we are of the view that we would expect intermediate and long-term yields to fall, sending their prices higher. I think there is a lot of misunderstanding around that, especially among individual investors, kind of a big client base of ours here at Schwab. Why would Treasury prices, especially long-term Treasury prices, rise? Well, as Sam mentioned too, liquidity would be an issue, and even though this would be a short-term default in our view, should it happen, it wouldn't impact the ability of me or you to receive our 10-year Treasury note maturing in 10 years. So we think the safest, most liquid investments would still get bid up, and we would expect intermediate and long-term Treasury yields to fall should this not get resolved over the next few weeks.
In that very specific instant, things aren't different this time around. 23 minutes away from the opening bell, equity futures just about positive by 0.1% on the S&P 500. A little bit earlier on this morning, we had some economic data from the Empire Manufacturing read on things. I have to say, Colin, not tremendous, not terrific. When you think about the debt ceiling showdown, what does this mean for growth going forward from here?
Yeah, it's more sign to us, more evidence that growth is likely to slow and continue to slow in our view. But we have seen a number of these indexes, kind of the regional Fed manufacturing index, point to slower or slowing growth. Yet the markets are kind of still showing some resilience, and we haven't seen it resonate into some of the actual hard data. So I think tomorrow will be really important with retail sales, because like I mentioned, these are a lot of manufacturing indexes, but when we look at the consumer spending is still holding up well. It's not going gangbusters. But as long as the consumer is still spending, and as long as the labor market is still somewhat strong, I mean, it is showing some cracks, but it's still relatively strong, it seems like that's going to be in focus more than these manufacturing indexes that we've seen over the past few months.
I just went through the intraday scores. Equity futures just about positive, but rolling over into the opening bell. Year to date on the S&P 500 up more than 7%, the Nasdaq up by something like 17%. Laurie Calvasina of RBC had this to say on the debt ceiling standoff and what it ultimately would mean for the equity market. Debt ceiling fears in the US equity market seem likely to provide yet one more catalyst for the large cap growth trade, which has benefited from one catalyst after another already in 2023. Sam, can I go to you on that and just read that quote again? Debt ceiling fears in the US equity market seem likely to provide yet one more catalyst for the large cap growth trade. Sam, would you agree with that?
I think the argument here is that will keep rates under pressure and in turn support that segment of the equity market. I think the key point I'd make here is sort of bringing it back to what all this means for central banks and for the Fed, because we're in a scenario here where the Fed explicitly has said that tightening credit conditions, any weakening in the equity market that feeds into that, will do some of the work for them. So if we see some weakness in equity markets as a result of the debt ceiling, I think that does some of the Fed's work for them. And that could happen actually in both scenarios. It could happen in a scenario in which something goes wrong. Clearly, we understand the implications there. But I think it could also happen in the scenario that both Colin and I were saying is much more likely, where there is an extension, but liquidity contracts. And that contraction in liquidity causes a bit of a catch down in the US equity market and US credit markets to what we think the fundamentals are suggesting those markets should be trading at.
Equities right now just about positive on the S&P. Let's get you some movers. We can do that with Abby.
Hey, John. Well, one big mover this morning really helping out the major averages. The shares of Meta are climbing. This as Loop Capital has upgraded the stock to a buy from a neutral, saying that the revenue trends there are very positive and that this should continue to drive multiple expansion as opposed to the cost-cutting one-time deal. For a stock that's up almost 100% on the year, this is a pretty bold call. On the other hand, Loop Capital is downgrading Alphabet down 1.3%. The AI transition, that creates concerns, and that valuation could remain volatile. This after an up 11% week last week, so taking some chips off the table. And then finally, Sarepta Therapeutics up 25%. The FDA has recommended approval for the company's gene therapy for a severe inherited muscular disease. The stock on the open, if these gains hold, will now be up on the year, John.
Abby, thank you. More from Abby around the open in about 20 minutes from now. Colin and Sam are going to be sticking with us. Coming up, Chairman Powell capping off a busy week of Fed speak.
The Fed has done a very good job of continuing to support the economy while raising rates and trying to tame inflation.
A conversation up next.
The Fed has done a very good job of continuing to support the economy while raising rates and trying to tame inflation. And so this delicate balance has allowed, I think, the consumer to continue to stay afloat, which pushes out our recession call to the end of the year.
Fed officials dominating the calendar this week, at least 11 different officials on the calendar this week, with Bostic, Kashkari, Cook kicking things off today. Our very own Mike McKee speaking with the Atlanta Fed President Raphael Bostic at 2 Eastern. US retail sales coming on Tuesday. All of this ahead of the main event with Fed Chair Jay Powell on Friday. Joining us now from the Atlanta Fed Conference down in Florida, Bloomberg's Mike McKee. Morning, Mike.
Good morning, John. It's going to be a very interesting week because, as you mentioned, there are so many different Fed speakers this week. But it's not going to be about what they say, I think. It's going to be more about what they don't say, the word you don't hear. And I talked to Fed officials in California on Friday, and I've talked to some here already. The word they don't say is pause. They're still considering the possibility that they might have to go higher on inflation because it doesn't seem to be coming down as fast as they want. We got that surprising speech from Mickey Bowman last week, and she is speaking again this week. And the others are all saying, well, you know, you look at the numbers, we're still high, and we are still seeing some inflation in the pipeline, so we're going to be very cautious and not decide till the very last minute. There's also some economic data this week that's going to matter. We already got, as you mentioned earlier, the lousy empire number. We get industrial production tomorrow along with retail sales. We'll see if industrial production ratifies the lousy empire number, and that would scare people. Retail sales, obviously, we want to see if the consumer is still hanging in there. And then later in the week, we get housing numbers, and there's an undercurrent among Fed officials of concern. I wouldn't call it worry, but concern that all of a sudden we're going to see housing turn around. Nobody's selling their houses because interest rates are too high, but prices are still going up because there's no inventory. So the question is, do they get a boost to GDP and a boost to growth and a boost to inflation from housing? We'll watch those numbers as the week goes on as well.
Mike McKee, let's go through the Fed speak together. Bostic, Kashkari, Bostic, Cook, Mester, Barr, Williams, Gorsby, Logan, Bostic, Jefferson, Barr, Logan, Williams, Bowman, Chairman Powell. Is that enough for you, Mike? What are we looking for from those speakers this week?
Sounds like a very long law firm title. I think Jay Powell probably is going to disappoint people who want guidance on what they're going to do. It's a research conference in honor of the late Tom Laubach, and I think he and John Williams are probably going to be doing more tribute type and more talking about research work. So that may not be the main event of the week, but we're going to have a lot of comment from, as you mentioned, Bostic, Barkin, Goolsbee, Mester is speaking, and these people are going to be asked the question, are we going to see you pause in June? And you can start adding those all up and you'll get a pretty good impression of where the Fed is right now. There's a couple like Lisa Cook, who's giving a college commencement I wouldn't worry about. But there's also Michael Barr, the Vice Chairman for Supervision, who is going to be speaking up on Capitol Hill, 2 hearings about the banking system. And obviously people are going to be looking for clues to how the banking system is doing right now and whether the Fed fears another meltdown at all.
Mike, looking forward to your conversations. That's for sure. Mike McKee there. Thank you, sir. Sam Linton-Brown, Colin Martin back with us. Colin, I want to come to you on a quote from President Bullard of the St. Louis Fed. He said this: monetary policy is now at the low end of what is arguably sufficiently restrictive given macroeconomic conditions. He said the prospects for continued disinflation are good but not guaranteed. I want to pick up on that first line, Colin. The monetary policy is now at the low end of what is arguably sufficiently restrictive. Do you agree with that?
I think I do. I mean, this is in line with what Bullard's been saying for the past year plus. But when we look at the actual level of the federal funds rate and how much it is or isn't slowing the economy, you could argue that it hasn't done too much yet, absent the home and housing market, of course. I mean, that's what we're waiting to see. Obviously, that's what the Fed's waiting to see based on the changes to their statement. But he's been in the camp yet for a while that they need to get higher. I think it's a step in the right direction that he's acknowledging that it's at the lower end of what he might consider restrictive, but it is in line with him and his fellow hawks that do think there is some work to be done. At Schwab, we think a pause will come. We acknowledge that the last statement stopped short of that. We viewed it as an indication of a pause as opposed to an outright explicit announcement. But when you have Bullard, Kashkari, and then when you have Michelle Bowman talking about the possibility of another hike going forward, there's plenty of voices out there that think the fight of inflation isn't over just yet. So we think they can pause, but if we start to get inflation readings that are coming in hotter than expected, and we don't see those cracks in the labor market that we've been expecting for a few months now, then it is possible they could end up hiking more.
There are all these little disconnects between what the Fed is projecting, what the market is pricing, what the equity market is embracing. Sam Linton-Brown, you are not buying the soft landing happy talk at all, are you?
Well, first off, John, let me compliment you on your ability to do tongue twisters of different FOMC speaker names. Super impressive. But with respect to the Fed, just 3 quick points our side. First is, I think the market will be more sensitive to data than it will to Fed rhetoric. At this point in the cycle, data matters more. We're seeing that in terms of what the market also implies in volatility markets, where the premium attached to central bank events is going down. The premium attached to data is going up. Second point I'd make is that even though the Fed, as we've just been discussing, still have a tightening bias, don't want to use the word pause, and suggest they might still have some more work to do, we're going to have persistent front-end inversion in the curve because the more plausible, larger move in rates from here is down, not up. And that means that even if the Fed do still have a little bit more work to do, it's highly likely that the market continues to price this risk premium attached to lower rates over the next 6 months. Third and final point, the reason the market's quite excited about these steepener trades is because of the point I just mentioned, that if the Fed cut, they'll have to cut quite a lot. The view that we've got here at BNP Paribas and our new head of US interest rate strategy, Will Marshall, has been advocating this perspective. The problem with steepener trades is that if, as Colin was suggesting, the Fed do have a little more work to do, or they want to keep rates higher for longer, those trades are very negative carry. And while you can have a persistent front-end inversion that stays priced, if the cuts aren't realized, you're losing money as those cuts get rolled incrementally forward. So the way that we've been advocating to position around that is to be in the steepener trades, but against it be short US rates vol, which can only be justified at these levels, in our view, if you do have a hard landing.
Colin, what would you say back to that?
Well, I want to touch on a point that Sam made that we agree with, where he alluded to when the Fed cuts, it might be large cuts, right? And the Fed only needs to cut or will only cut if they need to. And that's a point we've been talking about. So if we look at rhetoric from Fed officials, their dots versus what the markets are expecting, we tend to lean more towards the Fed, although we'll acknowledge that if inflation does come down and we start to see more cracks in the labor market, maybe we can see cuts this year. But as it stands right now, with inflation still 4% plus when you look at core readings, and a labor market that's still relatively strong and an unemployment rate still at 50-year lows, the bar seems pretty high for a cut because the Fed has told us they want to kind of hold and see what the lagged impact of all these hikes are. So given all that, we don't think they suddenly want to do something to stimulate the economy or potentially stimulate the economy if inflation is at still 4% or more. So that's been our case for a while. But again, we do see the risk of cuts if we see that disinflationary trend maybe pick up a little bit and we start to see more cracks in the labor market. We started to see a little bit with initial jobless claims, but again, one indicator, 1 week doesn't necessarily make a trend.
True. Looking out for claims again this week. Colin, Sam, to the two of you, thanks for joining us. As always, looking ahead to another read on the US consumer this week, with retail sales coming tomorrow, later in the week earnings from Target and Walmart. This is what Mike Gapin of Bank of America had to say on a consumer and the credit card data they track, the card spending data at B of A. So far, the card data point to a relatively benign consumption slowdown and few signs of bank stress weighing on spending. That's the latest take from B of A. A lot of people sharing that view at the moment. We'll pick up on it a little bit later. Coming up, the morning calls and later, preparing for a pause. BlackRock's Gargi Chowdhury telling equity investors to go for growth. That conversation around the opening bell. Your opening bell about 7 minutes away. Equity futures positive 0.16%. 5 minutes away from the opening bell, coming off the back of a very small week of losses on the S&P 500, trying to bounce back by just 0.16% on the S&P, going into the cash open. That's the price action. Let's get you some morning calls. First up, Loot Capital upgrading Meta Platforms to buy. 320 price target, growing increasingly positive on the company's revenue outlook. Deutsche Bank upgrading DuPont to buy, $80 price target, highlighting the stock's attractive valuation after underperforming its peers. That stock is positive by a little more than 3%. And finally, your third call from Bernstein, upgrading Tapestry to outperform, pointing to strengthening China demand and improving inventory levels. That stock up to 42, positive by 2% in the pre-market. Coming up, BlackRock's Gargi Chowdhury expecting a pickup in volatility as the Fed prepares to pause, and why this growth trade might continue to deliver. That conversation just around the corner. Your opening bell up next. Let's get your trading week started. About 22 seconds away from the opening bell this morning. Good morning to you. Equity futures positive by just 0.1%. Coming off the back of a couple of weeks of losses on the S&P. Let's see if we make it 3 going into retail sales tomorrow and a ton of Fed speak through the week. Let's the opening bell switch of the board and get to the bond market. Yields looking a little something like this in the Treasury market. We reclaimed 350 on a 10-year, up by 3 or 4 basis points. In the FX market, a euro 108, 108.79. Only a couple of weeks ago came very close to 111. Backed off since then. Last week, biggest weekly drop on euro dollar, going all the way back to September of last year. In the FX market right now, the euro against the dollar positive by 0.3%. Crude up by 70 cents right now to $70.80. We're up by about 1% on a session at the moment. About 26 seconds into the session, your broader equity market on the S&P 500 looks like this. We're positive by 0.1% on the Nasdaq. No drama here this morning, up by 0.1% as well. Kicking off the new week with plenty of M&A news. Newmont securing a $19.2 billion deal for its Australian rival Newcrest Mining, plus Wano agreeing to buy Magellan for $18 billion, creating one of the largest oil pipeline operators right here in the US. Abby has more. Hey, Abby.
Hey, John. Yeah, well, we do have these 2 commodity space deals on this Monday, so some M&A action for commodities. Starting off with the Newmont deal, that $19.2 billion purchase of Australian rival Newcrest Mining. Now, this will cement Newmont's position as the largest gold miner in the world. The deal is pending regulatory approval. It's the gold mining sector's largest deal to date, larger than the Goldcorp purchase by Newmont back in 2019. Gold up more than 10% this year at an all-time high suggests that Newmont thinks more gains ahead. Now, as for Oniak, they are buying Magellan for $19 billion, an energy pipeline deal. The agreement should create one of the U.S. Largest pipeline operators. It allows them to expand into oil and fuel transportation. A cash and stock deal, a 22% premium. It's really interesting, John, because Magellan up just 14%. That suggests some folks may think that there are some issues, maybe on the regulatory side, to getting this deal done at the end of the day.
Abby, thanks for that. The latest there for some of the mergers and acquisitions this morning. Some activist action in the food industry. Shares of Shake Shack moving higher on a Bloomberg report that activist investor Engaged Capital has taken a stake with plans to push for changes on the board. Katie Lights has more. Hey, Kaylee.
Hey, John. Yeah, Shake Shack up more than 5% here in the first few minutes of trading. We understand that Engaged has a 6.6% stake in the company and is looking for 3 board seats in this proxy fight. We understand that they actually wrote a letter to the board of directors back in March detailing the proposal for new directors as well as other changes to boost the stock price. Mind you, the stock is with these gains today, now up more than 60% year to date, up by 25% in May alone, as it was boosted not just by this report, but also positive results earlier this month. Look out over the longer term, though, John, and you see a very different story. Shake Shack is still trading at roughly half of the levels of its all-time high from back in February 2021, down more than 45% since that time. That is dramatically lagging some of its restaurant peers, which are up about 20% over that same time period. So in theory, Engaged here trying to help Shake Shack play catch up, John.
Katie, on the latest, Shake Shack right now up by more than 5%. Looking at the financials, we've focused a lot on it for good reason since early March. The regionals, the KRX regional banking index from KBW hammered last week by more than 6% this morning. Just about positive by 0.25%. Big week ahead for the banks once again. The National Economic Council Director, Lael Brainerd, attempting to soothe those fears ahead of congressional hearings on Capitol Hill this week.
The environment has changed a lot over the last few years, with interest rates going up by a large amount. And banks, several banks that have now failed and been taken over by healthier banks, didn't manage their risks. Right. Those were isolated problems. But of course, we're all monitoring the situation very carefully. But we have the tools. We've taken strong actions. The system overall is sound.
Hey, Shonali, they all get sent the same script, don't they? It just reads, the system overall is sound.
That certainly is the script that we're listening to. And of course, you're watching the investors across the board see if that is true. You were talking about the KBW Bank Index. Coming out of last week, there were barely any stocks in that index that were in the green on the year, John. And if you looked at the only things that were really flat to up, it was Citigroup and JP Morgan, everything else in the red. So if you take a look at the green that we're looking at the screen right now, there are a few things. Schwab in particular, you're looking at it get another day of gains here after saying late last week that really the position there is stabilizing when it comes to deposits. They have about $13 billion in net new assets last month. Can they continue that stability? You are seeing them still down more than 40% on the year into this morning, but you are seeing another day of gains. Now, PacWest as well, we know that this is a bank that has seen a lot of pain in the last 2 weeks. Is the position there stable? Now, when you look at how the Fed speakers are looking at this, is the banking system stress enough to really show you more strains in the economy? When you're looking at the credit crunch, you are certainly seeing signs of cracks, but you're also seeing some signs of optimism. Still a little too early to tell where this goes from here. Certainly no banks, as we're looking at it right now, in kind of danger territory.
Shonali, looking at Schwab, it's positive this morning by more than 3%, and there's a Southside research call I'll get to on that in just a moment. But Shonali, why did this name get dragged into this mess of the last couple of months?
Well, think about just how volatile the assets have really been. Think about how volatile the stocks have been. So some of this was sentiment dragging things down more than maybe it otherwise would have. But let's be clear here. Schwab turned into a bank. In fact, it had several banks here that were definitely very investors were very concerned about the interest rate risk that was baked in here as they changed strategy so rapidly in the last couple of years. I like how Torsten Slok had put it. For so so many years, higher interest rates were seen as such a good thing for banks. But when they rise this rapidly, we've seen that that is certainly not always the case.
Shanali, thank you. Schwab back at 50. Back at 50 in early trading and positive by a little more than 3%. There's that call from the likes of Raymond James on Charles Schwab, upgrading the name to outperform and running the following. Recent data indicate that client cash sorting at Schwab is tapering. Concerns about the stability of the banking system have not impaired its ability to attract new accounts. And as a result, we see deposit balances stabilising starting in the third quarter of this year. That name at 50.50. We're positive there by a little more than 3%. Joining us now to discuss, I'm pleased to say, is BlackRock's Gargi Chowdhury. Gargi, wonderful to get you on the programme with us as always. You put this in your recent outlook. Here's just a snippet of it. I'm going to share a quote with the audience that investors may want to consider stepping into high-quality, medium-term fixed income. For equity investors, we prefer growth companies with a strong quality tilt, high returns on capital, margin stability, and solid balance sheets with reasonable valuations. Now, Gargi, does that just take me over to tech and to the big growth mega cap names on the S&P 500?
Good morning, John. It's great to be here. Thank you for having me. And it's a little bit of the higher quality tech names for sure. But when we think about quality companies, think about companies that actually have that margin resiliency, that pricing power, that earning stability. It doesn't just have to be tech. And I think that's where we often get confused. We think growth, we automatically think tech. But what our work shows that, yes, it can be some of the tech names, but it can also be sectors like energy, especially global energy companies that do have that tremendous amount of pricing power as well as margin safety. So, as we sort of think about what's to come next, which we view as a pause, the Fed is getting ready to press that pause button. We'll find out more in June. We think quality should remain the focus, both in the fixed income markets as well as the equity markets.
Gargi, one thing that you've said is that a pause is not a pivot. Can you draw the distinction in how you would trade accordingly?
Of course. What the markets are pricing in now when we look at the Fed funds futures, and we see this even after the CPI print and the Michigan number, is that there are going to be some rate cuts by the end of 2023. Now, when we look at what we got in CPI, there's some good news there for sure. We are seeing that deceleration in shelter inflation in rents and OER, and that's excellent news for us as investors and certainly for the Fed. But at the same time, we're still seeing inflation remain on a year-over-year basis at 5.5% on core CPI. And that is not a world in which the Fed is going to jump to cut rates. So the pivot that the market has been expecting and has expected in the past is this idea that we get rates to that very restrictive level, which is where we are now, call it 5 and 8%, and then pivot to cutting rates. And we've seen that price action happen over and over again. And our view here is that a pause is exactly that. They stop here for some time. How long could that be? Certainly till the end of that year. Maybe after that, in the first quarter of next year, they can revisit where inflation is, where core services ex shelter is, and make a decision based on that. But for now, for the market to get ahead of themselves and expect for rate cuts to come as early as July seems a tad bit optimistic given the inflation backdrop.
And Gargi, given what you anticipate, is that good or bad news for this bond market, for Treasury specifically?
With the bond market, it's interesting. That we've been talking about this concept of moving away from TINA to BARB, which is, of course, bonds are back. And what we mean when we say that is bonds are back as an income to your portfolio. But more and more bonds are also back, especially if we step out of duration just a little bit into sort of the 5-6 year part of the Treasury curve and look at something like the ag. We do think bonds can also be that diversification in your portfolio. Now, having said that, I know the two things that I just said don't go very well together because we are expecting a little bit of that cuts to get priced out of the market. So what I would say is, number one, focus on the cushion, the yield cushion that the bond markets have. And what I mean by that is that even if interest rates move up by about 70 basis points over the next 12 months, we can still have a positive return being invested in things like the ag. So that's one thing that the investors should focus on. And the second thing, and this is a big departure from how we were viewing the fixed income markets or the high quality fixed income markets from 2022 to 2023, is that right now, any backup in yields should be viewed as a buying opportunity. So right now, sitting right right around 350. Maybe we can wait to, get back to sort of that 360, 370 if we even get there. Obviously, if we get back to the low end of the range, which was 3.3% on the 10-year Treasury, I would sort of steer away a little bit. But view any backup as a buying opportunity because you do have that incredible cushion in the bond markets that wasn't available to you just 18 months ago.
Gagi, is that true right across the curve or only applicable to certain segments of the curve?
I would certainly keep those allocations sort of in the very front end because you do have that inversion of the yield curve. You are earning a lot of coupon and carry in the very front end. So owning things like sort of SHY in the fixed income bond ETF markets and all the way out to sort of the 6-year part, so going out to the ag, I think that would still make sense, which is about a little over 6 years of duration. Where I would steer away from is the very, very long end. So 30 years or 20 plus years, I still think that we could get that steepening. I do think we could see a little bit of a yield move higher there. We have expected some inflation risk premium to come back into the markets. That certainly hasn't been the case. But I'm not giving up hope on that yet. So definitely step out of duration, certainly step out of cash. Look at the 2 to perhaps even the 6-year sector. I would steer away from the very, very long end because I think that there could be a repricing higher in yields there.
Seeing that this morning, curve just a little bit steeper, led by the move at the long end. Gagi, thank you, as always. Always a pleasure. Gagi Chowdhury there of BlackRock. Your 30-year higher by 4 basis points. The yield on that is about 383 on a 10-year higher by 4 basis points also, reclaiming 350 at the very front end of the curve. 2's out to 30s, looking at the 2-year there, up by about a basis point and back through 4%. For the broader equity market, about 12 or 13 minutes into the session, we are totally unchanged on the S&P 500 to start off the week. On the Nasdaq, we're positive by 0.2%. As I've indicated a few times this morning, retail sales tomorrow, later in the week. Another read on the US consumer, looking at Target, looking at Walmart. Coming up on this program, Turkey's leadership hanging in the balance.
This week, many in the U.S. and really in the UK and across NATO are watching Turkey's elections very closely.
The presidential vote going to a second round. That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Atlanta Fed President Raphael Bostic. That conversation at 2 p.m. Eastern, 7 p.m. in London. This is Bloomberg.
This week, many in the U.S. and really in the UK and across NATO are watching Turkey's elections very closely. Those will likely be going to runoffs later on this month. Turkey, of course, being a key member in NATO, and a shift from Erdogan's power really could change how that relationship looks in terms of Turkey's relationship with Russia, with Ukraine, and also with expanding NATO. So I think that's where a lot of eyes are on right now.
A little bit of turmoil in emerging market economies. Turkey holding a runoff election in 2 weeks after President Erdogan failed to secure victory with Sunday's vote. This as Argentina prepares to unveil a set of emergency measures, wait for this, including a 600 basis point rate increase. The move would raise its benchmark rate to 97% as policymakers look to stem currency losses and inflation running at above 100%. For more, Bloomberg's Patrick Gillespie joins us now from Buenos Aires, alongside Damien Sassow here in New York. Damien, first to you, the latest news in the last hour. We're going to a runoff, a second round.
Yeah, I mean, Jonathan, do you remember back in 2021 when the AKP deputy responded to 50-60% inflation in Turkey by saying he suggested that they actually eat less? Well, guess what? The AKP is here and here to stay, it looks like. And it looks like Erdogan's positioned to win the runoff in 2 weeks' time. And so, Kılıçdaroğlu and the CHP, which is the centrist party, has made a good effort here. And we'll see what happens. But, Erdogan has 9 lives, and it looks like we're going to see number 10.
Damien, we've seen the market reaction. Initially, equities down. There was some talk going into this about whether we'd move away from the unorthodox approach to monetary policy in Turkey. Any reason to believe things are going to change, Damien?
Well, the interesting thing here is the spillover to EM is going to be limited, to say the least. I mean, we're talking about foreigners owning something on the order of 25 billion of Turkish stocks and bonds. That's down from 150 billion 10 years ago. I mean, it's going to have a minimal impact. But to your point, we can't expect to see a quick rush to economic orthodoxy in Turkey, and even if there's a change in power, just because structurally speaking, it's going to be a challenge.
The economic situation in Argentina here to make Turkey look good. Patrick, let's talk about these numbers. It's unbelievable. 97% interest rates, inflation above 100%. How bad is it, Patrick?
Good morning, John. We're going to face another volatile week in financial markets in Argentina here. Inflation on Friday hit 109% annually. That's the highest in 30 years. Goes highest since 91, since Argentina, at that time, Argentina was battling hyperinflation in the early 90s and late 1980s. That prompted, those numbers on Friday prompted the government over the weekend to put out some emergency measures, including a 600 basis point rate hike to 97% on the benchmark rate. They're also announcing more FX intervention in parallel markets and also on the official rate. So it'll be really interesting to see how much they'll let the official rate devalue and how much they're going to intervene on the parallel rate. Of course, all of this is happening before the presidential election in October, which feels like a long way away when we're dealing with 1 week after another of high inflation, high price hikes, volatile currency moves, and a lot of uncertainty.
Patrick, you're living it. Can you tell me why we're always doing this in Argentina? There always seems to be something.
I wish the answers were easy, but I think the diagnosis is a lot easier, John. It's constant deficits, it's lack of credible policy making, it's overspending, it's money printing, and in other cases, it's over-indebtedness. So the country is in a constant cycle between one crisis to another of over-indebtedness, overspending. I think at the root of this is a huge public sector here that's causing deficits in Argentina, and those deficits need financing and debt. Argentina has no access to international debt markets right now, so they have to print money, and that's only going to create more inflation in the near term and the long term. But I think everyone knows that things have to get worse before they get better in Argentina, before things stabilize.
Well, Damien, things are certainly getting worse. What's your take on this?
I think fundamentally the drought is really hurting things. I mean, it's depriving the economy of much needed dollars offshore. I mean, corn, wheat, and beans. So, you know, the fact that you have this drought has really been a bad thing. And I think you've just seen from late March to late April, locals removing $1 billion of dollar deposits within Argentina. So, I mean, it's an economy that's starving for dollars. And the blue chip swap rate, which is the parallel rate, is down 35% year to date.
Damien, 97% interest rates. I don't want to gloss over it. 97%, and Patrick just went through the inflation number from last week, north of 100%. Patrick,
it doesn't really help.
Go on.
Yeah, I was just going to add that the monetary policy tightening here, this is a very cash-focused economy. So when you raise interest rates, it doesn't have that effect that it might have in a more advanced economy like the U.S. or in Europe. Mortgages are more or less non-existent in Argentina. So hiking rates only provokes a sort of a desperation sense in the country, and people start to, remove dollar deposits as they did by $1 billion last month, and really take matters into their own hands. But there is certainly a boiling and brewing sense that panic is on the rise here, and people are worried about the prospect of potential hyperinflation.
Damien, I just want to give you the final word on all of this. What is the solution to what's happening in Argentina?
Well, it must be amazing, Patrick, getting up every morning and figuring out how you're going to convert your pesos into dollars just so you can, eat and pay for necessities. But I mean, for me, it's going to be about the elections in October. Patrick will probably know more about this than I will. But Patricia Bullrich, who seems to be leading in the polls, is proposing something along the lines of a buy monetary policy, more of a dollarized economy, such as the lines of we've seen in Uruguay or Peru. And so I think that is probably in the works at some point down the road. But my goodness, the $44 billion IMF package that needs to be reworked. I mean, we need to get there. We need to get there sooner rather than later.
Just amazing to the two of you. Thank you. Patrick, no doubt we'll catch up again soon. Patrick Gillespie there. Damien Sassa, two of the very best on EM right now on both Turkey and Argentina. Just a little bit of turmoil. I think putting it into some perspective for us here in the United States going into this debt ceiling drama. 23 minutes into the session, equity markets down by 0.1% on the S&P 500. Just working through the Bloomberg for you. On the Nasdaq, just about unchanged. And the bond market yield still just a little bit elevated on a 10-year by 3 or 4 basis points, 350. On a 2-year, up a single basis point and just south of 4%. Coming up on this program, we'll get you the trading diary. Almost 26 minutes into the session this Monday morning. Good morning. Just about negative on the S&P, down by 0.16%. That's the price action. Big week ahead. Here's the trading diary. Atlanta Fed President Raphael Bostic speaking with Bloomberg, 2 p.m. Eastern. Sitting down with Mike McKee. Don't miss that. Governor Lisa Cook, a little bit later this afternoon. Tons of Fed speak this week. I'll bring you some of that through the week, no doubt. President Biden and congressional leaders expect to resume debt ceiling talks tomorrow. Plus retail sales. The Senate Banking Committee holding its hearing on SVB, and Tesla kicking off its annual shareholder meeting too. We round out the week with jobless claims, plus Biden attending the G7 Leaders Summit over in Japan, and Chairman Powell speaking on Friday. From New York, that is it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.